The economic landscape presents a puzzle, a stark contrast between how people feel and what the numbers show. Picture this: a nation where the majority of consumers express deep pessimism about the economy, yet the hard data suggests a different story. According to the University of Michigan's Consumer Sentiment Index, people are worried. They're convinced that the economy is teetering on the edge of a downturn. But when we peel back the layers, the hard data tells a different tale. GDP numbers beat expectations, final sales are robust, and corporate profits aren't collapsing. This divergence isn't just a quirk, it's a critical part of understanding where the economy stands today. Why does this gap exist? Perhaps it's the lingering scars of recent crises, the inflationary spike, geopolitical tensions, and the fear that progress is fragile. Consumers feel the pinch of higher prices at the grocery store or the gas pump, but the broader economy seems to keep chugging along. This dissonance creates uncertainty, not just for individuals making spending decisions, but for businesses and policymakers trying to chart a course forward. The stakes are high. If consumer pessimism persists while the hard data remains strong, how long can this imbalance last? Could the weight of negative sentiment eventually drag the economy down, even if the fundamentals remain intact? Or might rising optimism in financial markets signal that the worst is over? These questions linger, casting a shadow over what should be a clearer picture. Amid this uncertainty, the stock market offers its own surprises, defying the doom-laden headlines. Take Hasbro, the toy manufacturer, as a case in point. At first glance, the company seems like a logical casualty of an economic slowdown. After all, discretionary spending on toys, games, and other non-essentials typically declines when consumers tighten their belts. Economic forecasts predicted weak performance, and media narratives amplified the gloom. Yet against all odds, Hasbro's stock surged. What explains this anomaly? Digging into the details reveals a story of resilience and adaptation. While the broader economy faced challenges, Hasbro leaned into strategic shifts, expanding digital gaming, leveraging nostalgia with classic brands, and strengthening its international footprint. Investors recognized these moves, betting on the company's ability to navigate tough conditions. The takeaway is broader than one stock. Markets are nuanced, capable of rewarding agility even in uncertain times. It's a reminder that not every sector, company, or investor follows the same script. While headlines scream about recession risks, some players are finding ways to thrive, challenging the one-size-fits-all narrative. This divergence raises a compelling question. Are we too quick to generalize economic performance, assuming uniformity where there is complexity? The market's reaction suggests that opportunity exists, even in adversity, for those who adapt. The McDonald's mystery adds another layer to this economic puzzle, exposing the tangled relationship between tariffs and business performance. At first glance, the fast food giant appears to be a victim of trade policy. Media reports point to rising costs due to tariffs on imported materials, pushing McDonald's to raise prices and, in turn, hurting sales. But a closer examination reveals a different timeline. Internal data shows that same-store sales began declining before tariffs were imposed, suggesting deeper issues at play. Was it shifting consumer preferences, increased competition, or operational missteps? McDonald's, a company known for its data-driven strategy, has worked to refine its offerings, invest in technology, and streamline operations. Yet the narrative persists: tariffs are to blame. This case study illustrates a broader challenge. In an interconnected economy, isolating the true causes of business struggles is difficult. Tariffs may contribute to cost pressures, but they are rarely the sole factor. For consumers, this means that attributing price increases to a single source often oversimplifies a complex web of influences. For policymakers, it highlights the need to scrutinize claims with data, ensuring that decisions are based on evidence rather than assumptions. The real cost of misattribution. Misguided solutions that fail to address underlying problems. Now turn the lens to a menu item that has become a symbol of economic stress: the $4.19 cheeseburger. Fast food prices have soared in recent years, and the impact is palpable. For decades, McDonald's and its competitors offered affordable meals, a budget-friendly option for families and individuals alike. But as prices creep upward, consumers are forced to make choices they once didn't have to. A cheeseburger that was $1.50 not so long ago now costs nearly triple that. The fast food industry justifies these increases by citing rising labor costs, inflation, and supply chain disruptions. But there's a limit to what consumers will tolerate. Economists call it the price sensitivity threshold, a point at which demand falters because prices have risen too far. Signs suggest that threshold may be approaching. Sales figures show that while prices have gone up, transaction volumes have stagnated or declined, indicating that consumers are eating out less or trading down to cheaper options. The implications extend beyond fast food. If price increases in this sector trigger broader changes in consumer behavior, the ripple effects could reach retail, entertainment, and other discretionary spending areas. This isn't just about burgers. It's about the economy's ability to absorb inflation without triggering a spending slowdown. Beneath these surface-level shifts lies a more profound indicator of economic health: the labor market. While rising prices and shifting stock valuations dominate headlines, a slowdown in job creation may be the real canary in the coal mine. Employment drives spending. When people have jobs, they buy homes, cars, and everyday goods, fueling economic activity. But recent data suggests cracks are forming. Job openings are declining, hiring is slowing, and layoffs, while still historically low, are ticking upward. These changes may not feel dramatic on a day-to-day level, but they signal a shift in momentum. Experts warn that a weakening labor market could trigger a chain reaction: lower consumer confidence, reduced spending, and ultimately, slower growth. Unlike inflation, which can be managed through monetary policy, labor market trends are harder to reverse once they gain momentum. The Federal Reserve watches these indicators closely, knowing that its ability to engineer a soft landing depends on maintaining a balance between cooling demand and preserving employment. The challenge lies in distinguishing between temporary fluctuation and long-term trends. If the slowdown is merely a correction after an exceptional period of hiring, the economy may absorb it without major consequences. But if job losses accelerate, the risks of a downturn grow significantly. One of the most insidious forces shaping economic outcomes is the narrative itself. Negative economic reporting can become a self-fulfilling prophecy, amplifying fears and influencing behavior. Imagine a consumer who reads headline after headline about rising inflation, job losses, and looming recession. Even if their own financial situation remains stable, the constant drumbeat of pessimism can erode confidence. They may delay large purchases, cut back on discretionary spending, or hesitate to invest. These individual choices, multiplied across millions, can slow economic activity, turning fear into reality. This dynamic isn't new, but in the age of social media and instant news cycles, its effects are magnified. Information spreads rapidly, and narratives, whether accurate or not, gain traction before data can provide clarity. The result: a feedback loop where negative expectations shape outcomes, independent of underlying fundamentals. Breaking this cycle requires a delicate balance. Media outlets have a responsibility to report on economic risks, but sensationalism can exacerbate uncertainty. For consumers, distinguishing between signal and noise becomes crucial. A measured perspective, grounded in data rather than headlines, may offer a clearer path through economic turbulence. This leads to a fundamental question: does consumer demand drive employment, or is it the other way around? Traditional economic wisdom suggests that job creation fuels spending. When more people work, they earn income, which they then use to purchase goods and services, prompting further hiring. But recent trends challenge this sequence. In some sectors, declining demand has preceded layoffs, suggesting that weakening spending may trigger employment cutbacks rather than the reverse. Consider the retail industry, where reduced consumer foot traffic has led to store closures and job losses. Or the hospitality sector, where declining travel bookings may lead to reduced hiring. If demand contraction precedes labor market deterioration, it reframes how we understand economic downturns. The implications are significant. Policymakers seeking to prevent recessions may need to focus not just on employment metrics, but also on indicators of consumer demand, such as retail sales, credit card spending, and business investment. Recognizing this potential shift in causality could lead to more effective economic interventions, targeting both sides of the equation. To visualize this interplay between employment and demand, consider the bathtub of unemployment. Imagine a bathtub filling with water. The water represents unemployed individuals entering the labor force or losing their jobs. The drain symbolizes job creation, removing people from unemployment by employing them. The level of water in the tub reflects the unemployment rate. If job openings increase, unemployment falls. Conversely, if layoffs accelerate, the tub fills up, pushing unemployment higher. The key insight: stabilizing or reducing unemployment requires both limiting job losses and accelerating job creation. In a slowing economy, this balance becomes harder to achieve. If companies curb hiring due to uncertainty, the drain narrows even if layoffs remain low, leading to a gradual rise in unemployment. This analogy underscores the dynamic nature of labor markets and the need for proactive measures. Without sufficient job creation to offset economic headwinds, the unemployment rate becomes a measure not just of current conditions, but of future risks. One of the most concerning developments in recent economic data is the sharp decline in consumer income expectations. When people anticipate higher incomes, they are more likely to spend and invest, fueling economic growth. But recent surveys reveal a collapse in this outlook. Consumers expect stagnant or declining wages, diminishing bonuses, and reduced opportunities for advancement. This erosion of confidence has far-reaching consequences. Reduced income expectations lead to cautious spending, lower credit card usage, and increased savings, all prudent. Personal financial decisions, but collectively, they can slow economic activity. Businesses that rely on consumer demand feel the effects first, followed by broader sectors. If this pessimism persists, it could create a feedback loop where weak spending leads to lower corporate earnings, prompting cost-cutting measures, including layoffs, which further dampen income expectations. Economists closely monitor these trends, recognizing that shifts in consumer psychology often precede recessions. The challenge lies in distinguishing between temporary anxiety and a sustained shift in outlook. If income expectations remain subdued for an extended period, the probability of a downturn increases significantly. Tariffs, often portrayed as an economic blunt force, operate more like a slow burn, an insidious erosion rather than an immediate shock. Unlike the sudden collapse of a financial crisis or the abrupt shutdowns of a pandemic, tariffs don't trigger immediate catastrophe. Instead, they chip away at consumer purchasing power and business profitability over time. Consider the impact on savings rates. As imported goods become more expensive due to tariffs, households face higher costs for everything from electronics to clothing. To manage, consumers may dip into savings, reducing the financial cushion that protects against economic shocks. Businesses, too, face pressure. Companies reliant on imported materials must choose between absorbing costs, raising prices, or finding new suppliers, a process that takes time and investment. The cumulative effect is a gradual tightening of financial conditions, one that can weaken demand without the drama of a headline-grabbing crisis. This slow-burn nature makes tariffs difficult to detect in economic data, yet their impact is real. Unlike the abrupt collapses of the past, tariffs represent a more insidious economic force, one that nudges the economy toward contraction without the clarity of a single defining moment. As the economic calculus grows more complex, the Federal Reserve faces a daunting dilemma: when and how aggressively to cut interest rates. Rate cuts are a traditional tool for stimulating economic activity, lowering borrowing costs for businesses and consumers. But timing is everything. If the Fed acts too early, it risks reigniting inflation, undoing years of work to stabilize prices. If it waits too long, a slowdown could gain momentum, making recovery harder. The magnitude of the cuts matters, too. A modest adjustment might reassure markets without overcorrecting, while a more aggressive move, such as a 50 basis point cut, could signal deeper concerns. Investors watch these decisions closely, interpreting every word from Fed officials for signs of urgency. A 50 basis point cut would be a bold statement, suggesting that the Fed sees significant risks ahead. Such a move could temporarily boost markets, but it could also unsettle investors who might question whether the central bank knows something the rest of the economy doesn't. The challenge lies in striking a balance, providing enough support to cushion the economy without triggering panic or undermining credibility. One of the most telling economic relationships is that between wage growth and the Federal Reserve's benchmark interest rate. When wages rise faster than inflation, consumers feel wealthier, fueling spending and economic expansion. But if wage growth lags, even low inflation can feel burdensome. The Fed monitors this dynamic closely, understanding that wage trends influence both inflationary pressures and economic resilience. Currently, wage growth has cooled, yet the Fed funds rate remains elevated. This divergence raises concerns. Historically, when wage growth falls below the Fed funds rate, it signals economic trouble ahead. Workers have less purchasing power, businesses struggle with labor costs, and borrowers face higher debt burdens. This imbalance can slow economic activity, increasing the risk of a downturn. If the Fed cuts rates without seeing a rebound in wage growth, it may find itself in a precarious position, stimulating the economy while failing to address the underlying weakness in labor markets. The implications are profound. A disconnect between monetary policy and real-world economic conditions could reduce the effectiveness of rate cuts, forcing policymakers to rethink their approach. A 50 basis point rate cut would be more than a policy adjustment. It would be a message in bold type. Such a move signals that the Federal Reserve sees meaningful risks to the economy, warranting swift and decisive action. Markets often react positively to aggressive cuts in the short term, rallying on hopes of lower borrowing costs and renewed economic momentum. But the long-term effects depend on context. If a 50 basis point cut comes amid slowing growth and deteriorating labor market data, investors may interpret it as a concession that the economy is weaker than previously acknowledged. This realization could trigger a wave of caution, leading to further declines in equities as worries about recession intensify. Moreover, a large rate cut concedes that the Fed's previous tightening cycle may have been too aggressive, raising questions about the central bank's ability to navigate economic cycles effectively. The challenge lies in managing expectations. A bold move may be necessary to prevent a slowdown from spiraling, but it also risks unsettling markets that had hoped for a gentler path. Ultimately, the Fed must weigh the benefits of proactive support against the potential for unintended consequences.